Good morning, everyone. Today we have a relatively short meeting. We have one potential action item and one item basically for information and discussion. So with that, I'd like to call the meeting to order with the opening statement. Eric, are you going to read the opening statement?
Yes, sir. This is a special called meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you. Sandy, I believe you're going to take the roll call. Is that correct?
That's correct. Dr. Hackbart,
Here.
Mr. Cheatham,
Here.
Dr. Milkman, Mr. O'Mara,
Here.
and Mr. McGraw. You're on mute. You're still on mute.
I apologize.
There we go.
I
There we go.
apologize.
All right.
Okay.
We got you.
Okay. Thank you, Sandy.
You're welcome.
Sandy, I believe there are no public comments. Is that correct?
That's correct, sir.
Thank you. As I indicated at the calling to order, we have basically two items on our agenda this morning. One is a potential action item. It's a recommendation for an extension for the new Mountain 4 investment that we made back in 2013, and that the investment amount is present time at 7.2 million, and the request is for a 2-year extension. So I'd like to turn over to Steve for a discussion and further information about this particular request and your recommendation.
Thank you very much. Good morning. Appreciate everyone's time. And as always, definitely want to thank Sherry and Sandy for putting together these meetings on such short notice. It seems like we were just here with a different fund, a very similar request. And as we noted at the time when we reviewed kind of the investments currently in the CERS private equity portfolio, we're likely to be faced with several more of these over the coming months. Timing is always uncertain. We get notification when we get notification. It's usually some amount of lead time to the current expiration, and they tend to have a fairly tight window for response. Specifically in this case, as Dr. Hackbart mentioned, New Mountain Investments is seeking consent from the advisory committee and a majority in interest of the combined limited partners to extend the term of Fund 4 by 2 years to July 8th, 2027 in order to wrap up the operations of the fund. Importantly, for the proposed extension period, New Mountain has agreed to reduce their management fees from the current 50 basis points annually to 0. And with that, I will turn it over to Anthony to talk about the details. And we also have Wilshire on board, and their memo is included in the material.
Hi, everybody. Yep, like Steve said, this is a fund that's we've had for a long time, and we've already had a couple extensions that have gone through. As you can see, they've reduced the fees each time. And finally, they're at 0, like we think they always should be for extensions. So overall, the fund has done well. In the past, I think one of the board members asked what they've done with the past couple extensions. They've exited one company through a continuation vehicle, another one through a sale. So there's 4 left. Like Steve was saying, who knows if this is actually going to finish in the 2 years. One of the companies left is a rollover stake from when they've already exited it. So they're a minority within another PE sponsors deal. So that's not totally under their control. So this can keep going, but in the case of fees, there will not be any, so that's a little more palatable. And then so if you go to the next page, let's see here. Yeah. Thanks, Cindy. So It has done well, and I think it makes sense to allow the manager to continue harvesting the last four companies and for zero fees. We're good with it. So happy to take any questions if you guys have any.
Yeah, and I think as Anthony mentioned, a big distinction here relative to our last recommendation is obviously the concession and fees, which we think is important. Obviously, the manager still has skin in the game, and they're in line to gain from any realizations, upside potential to the remaining portfolio companies, which as Anthony mentioned, there's four left. They have been active. We have had. I think they recently sold one of the portfolio companies. They're actively working on selling another one. I do, as we always caution, just because there's a stated date, whether that's a maturity date or a term date, it doesn't necessarily mean that we're going to receive all of our money back then, or the investment will come to a conclusion. It's likely, given current market conditions, that even with this 2-year extension, 4 portfolio companies left, and they're working actively to liquidate those and have realizations that you may come back in 2 years, and this would not be an additional extension. Potentially, you just go into wind down, as we'll see in the next section. Some of that terminology doesn't necessarily mean a whole bunch, but in this case, given that they are reducing the fees, we feel it's appropriate to consider and approve the extension.
Just a quick question. I know from response you all gave me by email that over the last couple of extensions they've had, they've been able to liquidate portions of the portfolio and distribute those. Are there ongoing distributions even over this 2-year period? Either from revenue or dividend or whatever, or is this totally a capital appreciation issue?
There can be those. A lot of sponsors nowadays, if they're not able to do a control sale and get the price they want, a lot of them will run 2 processes. They'll do a refinancing process and take a dividend if they're not able to get the price they want, and then just continue to hold it. So that's another way for them to return some capital to shareholders, and not sell at a price that they don't think is warranted. So it's really up to the sponsor, but we have been seeing that as well from some people.
So there may or may not be cash flow over the next 2 years, even if they are not successful. And
yes, that's correct. There's nothing that obligates them to send anything back.
I see.
So
Right.
they could continue to hold it and just continue to, if they've invested in one of the companies, that probably did it at Fusion, and it brought the value up a little bit even after that. I think from the 1.1 to 1.2. So it's obviously has not been a great performer, that one, but they're still active with it and trying to make it exit at a higher value.
So our current position is 7.2 million. Is that correct?
That's correct.
Estimated. What was our original investment? Do we know? Do we have that?
Yeah, it's on the previous page. If you want to look at that.
Okay, I missed that. Okay.
Total commitment across for CERS was 45.2 million.
So
It was a $50 million commitment in the $4 billion fund.
okay, good. Right. Good. Any other questions, clarifications?
Hey, I do got a question. Page 10 or page
Please.
11, I think it is. Just, I apologize. I know I'm full of these. Can somebody explain to me the CRS value line?
Sure.
I think you need to be back a page, Sandy. Or no, I'm sorry, forward a page.
Yeah, that's it there, I believe.
Okay, all right.
Yeah.
That's
So
just the
the
mark.
commitment versus the value line. Explain that to me.
Sure. Commitment is what you say you're going to fund up front. So in the previous page, overall KPPA, we committed $50 million to what's a $4 billion pool of capital, and we have 10 plans here, and we allocate the capital among the different plans for a while, including back when this commitment was made. The 2 of the K plans did not commit to private equity, so the 50 million was allocated across the 8 plans that were doing private equity. And since CERS was a majority of the assets, they have a majority of the commitment. So that's why these numbers are all kind of funny, because it's they were maybe 50 or 78% of the commitment or something. And then
Yeah.
the value is what's left of of the remaining companies they have. So it's the values of the stakes that CERS has. So it's 4 companies in this fund. And if you give CERS their piece or their percentage of it, it amounts to that. And so it's just a market value. The commitment, I mean, that's just what's left. So it doesn't show like what's already been returned. It's just purely the market value that the manager has estimated.
Because like I said, for me looking at it, and I'm sure the majority of anybody else that looks at stuff has the same thought process. To me, it looks like, well, we committed 22 million. Let's just say on that page 11, let's go to that Blackstone 5.
Yes.
It looks like we committed $34 million, and well, we've got 14,000. So it's kind of hard to read. And that was a general question, not about this certain.
Sure.
Yeah,
And
I mean,
just a general question. It doesn't show well. We've made and I think I said this the last meeting probably, but as I was looking over this stuff, it's just for the normal person, somebody that doesn't know, somebody that's new like myself. This is kind of put you at pause when you first look at it and think, my gosh, we invested 34 million and we only got 14,000.
Yeah, it only shows part of the story, right, Tommy?
Exactly. Exactly.
I
So
understand.
that was my question.
And I think that the intent, the intent there, and typically for drawdown type funds, which these are, right, as Anthony said. So at the inception of the investment, when we contract with the fund and the manager, we commit $50 million, up to $50 million. So that's how much is available for them to call from us. And over an investment period, they'll say, okay, we found a new investment, send us 10 million of your 50, send us 5 million of your 50. And that adds up over time. They can distribute it back. And sometimes there's what's called recallable capital. So if they buy something, they sell it, they give us the money back. We made a bunch of money. They can call some of that money back. This is to probably provide, and again, when we talk about benchmarking private equity and all the different metrics that are available to us, this is really to provide a scale, both how old some of these investments are, what the original size was. So, at the time, CRS was hoping that the manager would call all the money, right, and invest it, and we'd get great returns from it. Most of that, the investment period for all of these are over. So typically they're not calling capital anymore. The remaining amount of our investments, you often hear us talk about these is the tails, right? So typically these are very small amounts, one portfolio company, two portfolio companies, a number of small investments that the manager has not been able to realize yet. So it's just kind of how big was the original investment or committed capital and how much of that is remaining. It's certainly not to say that we invested 22 million and now that investment is only worth, we haven't received any money back and now the investment is only worth a lot smaller amount. I agree. If we go back, Gary, go back, yep.
That was my thing. Somebody, that doesn't know, which like I said, I know a little bit about private equity, but not a lot. And I didn't mean to take this meeting in that direction.
Oh,
but
no, this is great information.
I was just wondering, but for the average person, it looks like, we've lost $16 million. I mean,
yeah, that'd be really
and we don't want to leave anyone with
that's
that
what
impression.
it looks like.
Yeah, we don't want to leave anyone with that impression. And Sherry, if you can go back to page 3 real quick.
And of course, Ed's email lets us know that we have not been losing money for sure.
So in this case, is Anthony put together here. So the 45.2 was the original commitment, and that's typically up to, right? A lot of times the managers won't typically call all of it because how much they call is based upon the investment opportunities they identify and they're successful in investing. So that's up to an amount. We didn't invest 45.2 and now have 7.2 back. If you go to the next page, Sherry, on the metrics slide. So some of these are metrics that we typically look at when we evaluate private equity, and Wilshire can certainly weigh in. They do a lot of work in this as well. But there's IRR, which is fairly typical for these types of investments. It has drawbacks. There's some gaming that can go on with IRR, but that gives you an idea of what you've made. That's akin to a lot of what we think about when we think about return. TVPI and DPI are both of what we've invested. What have we gotten back? So DPI is actually the realized. So we've gotten 1.75 times back our money that we invested.
Yeah, I
And
read the word.
yeah,
Of course, I was researching yesterday, and I know the DPI is very important. So, and 1.75 is excellent because I guess the kind of the gold standard is around one, from my understanding, from what I read. But
Well,
but that's
DPI
good.
of one just means you've gotten all your original invested capital back, which is good because
Yeah,
unfortunately we and other people have had funds that aren't 1x DPI. But yes, obviously you want it to be significantly higher for the risks that you took and the
gotcha,
illiquidity.
gotcha. All right, thank you.
Sure, of course. Yeah, and for the record, this like the Blackstone 5 fund you picked, that's a 1.7x net fund. So I mean, it's over. I mean, obviously most of it was invested a long time ago as a 19-year-old fund now. And it's been the small bits of it are just running off, but there's still a little left. So that's why that's on the sheet. And yeah, I think some of our other performance reports will show you the bigger picture, or happy to answer any questions that you might have.
So Steve and Anthony, your recommendation is to approve continuation. And well, sure, I read your note, you're endorsing it as well. Could you just clarify again, if we do not vote to support the continuation, what are the implications for us?
It's still going to go through. They'll still get extended. We are, as you saw there, I think we're a very small portion of the fund. So
Okay.
again, it's kind of that's not generally what we are trying to do. It's we'd rather be more port capital for the funds that we do choose to do, but there's different approaches. But yes, 50 out of 4 billion is not a super sizable thing that's going to influence the vote one way or the other.
yeah, and specifically in this case, they need both consent from the advisory committee, which they'll likely receive, as well as what's called a majority in interest of the combined limited partners. And what that simply means, it's a weighting, right? So as opposed to a 1-to-1, each limited partner gets one vote. It's weighted on exposure. So as Anthony points out,
Position.
Yeah, we get about one vote out of 100.
I see. Right. We're very powerful, right? Okay. Any other questions of Wilshire or Steve or Anthony? If not, I would accept a motion to approve the continuation on behalf of CERS.
I'll make a motion that we approve the continuation.
I'll second it.
Motion been made. Second. Any further discussion? If not, I'll signify by saying aye.
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 Opposed? Motion carries. Thank you, everyone. The second item for this morning's conversation basically is kind of the broader issue. As Steve had indicated, we have a number of these. I think presently, the information suggests we have like 21 funds that are 15 years or older. And I know it's creates stress and problems for our staff to try to monitor these, but I was wondering, is it possible to kind of have a plan about how we can deal with these? Steve, you mentioned that we get very short fuses on these continuations and so forth. To kind of monitor these as a whole, I'm not sure it's possible, but I think it may be worthy of conversation to see what could be done to so that our staff is not basically put in a position to have a short fuse to deal with us, and the board has to meet a couple of times. Is there a better way to manage this? I guess that's basically the question. Yeah.
Well, I think we can cover that in kind of some broad strokes, and then
Sure.
specifically
Thank you.
get into
Okay,
these.
please.
And I think this is a great topic. If you page forward one page, please. So this is the chart that we recently produced and presented to the investment committee and the board, and Anthony has added here. Appreciated the current fee status, management fee status for each of the investments there on the far right. And again, this is simply a depiction of the CERS private equity investments that are at least 15 years old. The key takeaways from the chart are collectively these investments represent less than 60 basis points of CERS total assets, with one of the investments accounting for over 40% of that exposure. So they're relatively small in the scheme of the portfolio. The majority of these investments are no longer charging management fees, as indicated there on the far right, with total fees across these investments of 240,000 fiscal year to date. So annualized, that's about run rate of about 320,000. So some are still charging fees. Obviously, as you've seen in the recent presentations, that is not our preference. That's not our, when we grant extensions, we like to see concessions on fees. Specifically to the point about the short fuse for these, most of these we won't see again in an investment committee or board. They're already kind of at that. They're not going to request extensions. They are in this, as Anthony points out, the status of winding up versus orderly liquidation versus extension. It's all kind of the same. It means that the managers are seeking the best economic value for the remaining assets in the portfolio, and when and if those are realized, us as the investors will receive liquidation and realization from that. I'm sure we've all seen that the headlines, and we've discussed at several meetings, the difficult liquidity and realization environment for private equity. I mean, we've seen numbers of 30,000 companies, $3.5 trillion in value that's tied up in legacy private equity. Some of it as old as what we have here on this page. You've probably also seen a number of headlines recently of large investors that really, I think, have either been forced or have elected to reduce their private equity investment portfolios. That's the denominator effect, where we all have these beautiful pacing plans about how much we expect to get back in distributions and reinvest. And, when that doesn't come to fruition and it gets tied up and markets are frozen in the private equity space like they have been, last year was the smallest, I think, aggregate in distributions globally on record. So investors not getting their money back, they've made commitments to new funds, or they have liquidity issues across their portfolio. They need options. Anthony mentioned, and we've seen it a couple of times, right? There's a number of somewhat creative ways that managers are approaching providing liquidity to existing investors. We've been part of that with continuation vehicles. You've also seen a number of different financing options that allow for distributions back. The two real options, I think, and Wilshire can certainly weigh in here as well. I know they have thoughts. They're in this market. There's at the highest level is kind of to maintain the investments as is until managers are able to liquidate the remaining positions. There you're hoping for both better market conditions, and that typically is on the financing and the transaction side, as well as potentially, economic expansion that makes the companies more valuable. There's also enhancements and improvements that are going on. The managers are working with the companies to increase the value and the attractiveness of those to investors, additional investors in looking for a sale. That's a path that we typically maintain. And that is because the other alternative is to seek a sale in a secondary market. We've seen a lot of those. We've seen some large, like we said, some large endowments recently, as well as other public plans have large sales of slices of their private equity portfolios on the secondary market. And that's a hot topic. I think Anthony and I talk about it. We see it daily almost, the rise in these secondary funds. Now, the caveat I'll say is when you see the rise and why there's such interest in the secondary side, and raisings for secondary funds is because the opportunity of the value that they see in either distressed sellers, forced sellers, people have to liquidate or make the decision to liquidate. The price that they're willing to liquidate those assets is attractive to a buyer. We see it a little bit in some of the CV vehicles, right? We've said in the past that you like to be on the buyer side of the CV because typically the better deal is being achieved by those that are able to provide liquidity. In a market like with current conditions, you're likely to see, especially on an LP secondary sale, a discount of 20 to 50%. It's a broad range, but it's going to be very asset specific, but 20 to 50% from where current marks are. So that means if you have an assets, one of these investments that's wherever they're marked, you're probably looking at least a 20% discount from that current mark. You also have, given that these are legacy, and that's what we're seeing sales of is a lot more of kind of what I would call less legacy, more current type of private equity investments, and those are the saleable ones. So that's where people have interest. How much interest would you achieve in or get back in some of these? You're likely to, if you went out with this entire book, you're likely to be bidless on a number of the positions, right? There's probably no interest based on the size, based on the age, based on what the asset is. That's a lot of work for someone to do to determine whether they want to put a number on something that has a very small value. And I would guess you would not see bids on several of these assets. So those are really the two options you have: is either to seek a secondary sale or to maintain the positions, and have some expectation that the existing manager is going to be able to ultimately unlock value and have some upside as they build a path toward an exit for the position, and hoping that broader market conditions improve for those assets. Anthony or Wilshire, please weigh in there as well.
Yeah, there's we have dozens of these funds, across I mean, what's fall to me as part of alternative assets. So real term, real estate. We also have some older funds, and it is not much of an administrative burden. Definitely, it would be much less than the cost it would be to run a secondary process and the significant discount that would happen if there was even any bids, like Steve said. So even current funds, we get emails because, like you said, it's been a hot topic, and so just folks who want intermediaries who want things done will send us emails about different funds that they have bid ranges and stuff, and you take it for what they're worth. But even current funds are in the 85 to 95 range. I think that's what you might have seen the Harvard and Yale portfolios were quoted in the 90s as well, and that's their portfolios, right? This is 15-year-old stuff. That's some of it's good, some of it's the dregs of it. So I don't think that's going to grow your 90% or 80. It's going to be low, like Steve said. And for a relatively small portion of our entire portfolio, it's probably not worth it. That's the calculation we've had since I've been here. I mean, the first week I was here, we talked about the CIO that hired me. We talked about legacy funds. So we're obviously aware of them and we'll keep tabs on what's there. But there's usually not a lot of action. And so we focus more on the more significant positions in our portfolio. But we know what's happening with these. And, I guess in terms of what would make this easier, I mean, until the IPS changes, these were delegated to the investment team. And most of the time it's no response because with small percentages of each fund, we're not going to influence it. And oftentimes with fees, we aren't going to agree. So we just abstain. So I would say it's not much of a burden. And the way to manage it would be probably delegation. So
I guess my question is, are there any opportunities in the secondary market that would justify?
You mean as buyers or you mean as us selling?
As buyers, yes.
Yes, we look at that a lot.
But with the
I think like
discounts,
Steve said, though, I think like Steve said, the discount, the issue that we run into is just there's so much capital to put to work, right? Like the existing GPs already have a lot of dry powder. And then you've probably seen this year, I think Ardian and Ares both raised 25 billion plus secondary funds. It's a lot of money to put to work. And even if they, even some of those funds could take down the Yale and Harvard pieces themselves, they're not. They're splitting with other people. I think Lexington raised over 20. There's many secondary funds that are quite large, and I mean, me and Steve always joke about how do they such buy everything? Like, I mean, this is not that big of a market, and so you have these, few very large players. They're going to look at all of things. We can name them. We've get the materials from most of them. But yeah, so we've monitored, but it's with all those funds competing, the discounts are, they're only, on the other side, for really good assets, they're going to have to compete with that. And then you have to look at how much leverage they're all using to be able to make the IRR calculation work for them. So it's something we monitor, but hasn't been of interest yet in PE. We have looked a little bit at real estate secondaries because those discounts are wider. There aren't as many players focused on that, but we have had a few come across our desk. I think you guys know that we have not been wild about the drawdown real estate. It has been, and I think our predecessors didn't think it was attractive. They were right, and that's starting to turn a little bit. But yeah, So that I would say real estate or real asset secondaries may be a more interesting area, but in private equity, there's just a lot of capital don't have to.
Yeah, from our perspective, we spend a lot of time in the secondary market, both as buyers and sellers. A lot of the demand, the demand for secondaries has really picked up. The volume for secondaries has picked up. On a positive side for a seller, the pricing for secondaries has picked up. For high quality, probably a little bit more current portfolio, you're actually in a 10%, 11% discount range. The average transaction is probably about 80, I think it was 83 to 85% across all private equity. Buyout, you're going to get about a 15 to 20% discount. Venture, 30 to 50% haircut. Somewhere in the middle. This portfolio, I look at it, it will all sell, as a package, with the exception, the challenging ones here I see. Actually, one of your largest, Horsley Bridge, it's a fund of funds. Those are a little bit less likely, and they're venture, but it is high quality venture. So you actually might be a little bit surprised. These are in terms of options. I agree with Steve and Anthony in terms of kind of direction. You could either do a full sale, which this whole portfolio of this type, you're probably talking about a 20 to 25% discount at least on the whole portfolio. The transaction cost on it is probably about 1%, in terms of the fee that you do. So let's say on the $100 million portfolio, you're gonna pay, call it $1 million fee on the buy sell. On the flip side, you'll have capital deployed. We regularly do secondary sales when the ratio becomes less than 0.1. So you asked the question before on, what's the CERS value relative to the commitment. So if you look at that, Arcano, it's at 6.5 million to 22. So when that gets down to about 2.5 to 3 million, that's where we usually programmatically try to sell our portfolios when those things get down below 10%, because it's usually there's not much upside remaining. They tend to be a bit of a drag, and they'll sit around for 10 years. And we think we have a better kind of use of and deployment of that capital. I think from some things that you could do outside of selling it or hiring a third party to kind of manage that out. And like Anthony said, I don't think there's a lot of, you could do this yourself, and I don't think it's a huge lift. But if you wanted the headaches and everything, that's one way. The other way, as Anthony mentioned, is delegation. I think as we do the IPS, the way that we have exposure to 300 plus funds and have multiple extensions coming to our committee every day. The way that we approach it is we do it a little bit more programmatically, and where we have defined definitions of if these things occur, if this is a fund that's in good standing, that performance is okay, there's no GP or material issues, they're asking for an extension and they're not charging fees. It's basically an automatic approval. So we set up certain scenarios, like internally we approve things that have those characteristics that will be approved. We use judgment, where if we think there's going to be a conversation or that somebody might have a different view, then we bring it to our IC. So I think one way to do this across this funds, as Anthony mentioned, is you could build it into your IPS, where here are the 7 or 8 scenarios, and they're common, that occur. And if this happens, it's basically we're going to approve it. And if this happens, we're going to abstain or not approve it. And if there's any uncertainty, then we bring it to the board, and that will materially reduce the amount of kind of these type of calls you have that are, for people in the industry, these are relatively common occurrences. And as the rest of your portfolio ages, they're going to become more and more common.
And Mark, maybe just a quick comment on going to the secondary market. I'm sure Anthony and Steve have, gone and tried to get a bid on some of these funds as well. That can be done fairly quickly. So if there's a desire on the board's part to know what the haircut is, instead of having this large range of 15 to 25%, that's something that can be figured out fairly quickly. So if there is a desire to pursue secondary, at least you have an idea of what that haircut would be.
Yeah. And it'll be a range, but yeah, you get a turnaround, and we could help facilitate that for you. We're doing it currently with some of our older portfolios, so we're in talks with several of the agents that are bidding on our portfolios. When we go to evaluate it, we could certainly add this to the mix and get you back something at least with a range within a pretty short period of time.
I
It seems like-
realize this is a small dollar figure, but you know, $100+ million, pretty soon you're talking about some real money. It seems to me like, I certainly would be interested in knowing what we're looking at if we were to go. But I think I'd also be interested in knowing a couple of different things based on what I'm hearing you all say. I'd be interested in knowing, particularly on this grouping of funds that we've got out there, what's been our return on these legacy products over the last 1, 3, and 5 year period of time. Obviously we're making money, that's a different story. But if they're not producing and they're lagging, then that certainly opens up the next question of what do we expect them to do going forward if we're dependent on a low interest rate, growing economy environment, which I think both of those are, kind of up in the air at this point in time. And then the third part of it is, if we were to free up that cash, what's the opportunity to go to? And, right now, I think everybody's probably got the same consensus that, private credit's probably a good thing to measure that opportunity cost against. So I'd be interested in seeing those numbers and those thoughts as well.
And
But I
that's
think
those
I
are
think
yeah. Sorry, those
think
are all really good points, Anthony. Sorry, let me jump in, then you can add. The difficulty, as we've talked about with private equity, especially, is that short-term performance, and especially for some of this legacy, marks are marks, right? I mean, they can market whatever they can mark any company or any portfolio whatever it is. What we say is you can't eat that. You're going to eat whatever comes back to you. So whatever the performance is on the realization. So it is more of a prospective. I wouldn't look at any of these and say, what are we reporting for performance for the last, 9 months, last year, because I don't think that's real. Right. I mean, as we've seen, it's that's a mark. The reason we would hold these is the expectation of what the ultimate realization, that's the return that we would look for. And you're right. If we look at one of these and we say that the prospects aren't good, now the counter to that obviously is if we view it that way, the bid may come back that way too. Is the value for what someone's willing to pay for that asset if they have a similar view on the outlook and the prospect of ultimate realization is going to be depressed from maybe even what the current mark is.
Yeah, but that brings the other side of the equation into question as well. If what I hear you telling me that they're sitting there giving us an exceedingly high valuation, is it really a 20% haircut? It might really only be a 5 or 10% haircut versus what the actual value may be.
Well, and the haircut, you're correct. The value is what the value, right? The value is what someone's willing to pay for it. The haircut is talked about from what the current mark is. So that's what we're carrying it. That's what, it's on BNY books and records. That's what the last 12 months, that's what's been impacted in the overall performance of the funds, is whatever that mark is. I mean, it's similar to every other market, right? Public or private. The mark is what the mark is. The value ultimately is when you find a buyer and a seller that agree to a price. So I only say that as and Mark may weigh in here too, is that, when you look at short-term performance for private equity, especially, it can be a little misleading because the numbers are a little less meaningful than what you'll see in public markets where you see daily marks or intra-minute marks on assets.
Yeah, they just start generally marked in the same way public equity is. Like that's how you analyze those managements, 1, 3, 5, 10-year track records. You just have to kind of look over the fund. The way that it's usually measured is against public market equivalents over the same time period. But yeah, just the trailing things don't really tell you a lot. But also the thing about it for what we were saying, I mean, yes, it's good to redeploy the capital, but you also are down, 20 plus million in the hole from where you were if you you crystallize the discount, so, or crystallize the loss.
Yeah, but
To somebody.
part of that 20 million is just on paper, do we really have it?
I mean, that's a fair question. I mean, yeah, that's a large industry debate about the mugs. It's fair.
It sort of strikes me as that
You're
this is
asking,
that
you're
we
asking
have-
all the right questions, and
Mhm.
and those are great points. I think the reason why a lot of people will sell is that time value of money. Like it's not that I don't think the marks are overestimated necessarily. On average, most funds when they liquidate or when they actually sell, they're selling for valuations on those underlying companies higher than where they're marked at, especially in higher quality GPs, which I think you have a lot of. They're selling because it's taking a spot in their portfolio that you're making an assumption. What's your private equity assumption in the portfolio? You have a 10% allocation and it's a 3% premium to public equity. Do I think this portfolio right here is going to be 3% above public equity? Probably not. So you're kind of giving up that additional return. So when somebody's giving you a 20%, 30% discount, it's because they look at, Arcano and they say, okay, this is going to sit here for the next 4 years probably. It's probably going to return, uh, you know, zero. You're hoping you're going to get your value back. Maybe it's appreciating by inflation or a little bit more, but you're not getting that 10% return. So the discount that they're paying is when I'm a buyer, I want to get 1.4 times or 1.5 times my return and a 15% return. So if I assume Arcano is not going to appreciate much from here on in, or less than that appreciation, I'm going to discount that to the amount that I'm going to get my 15% return. So, everything will sell. Now, if I have to discount that 60% to get my 50% return, or I have to discount a 20% return, that's what I'm kind of judging that evaluation on. So a lot of people will sell it, even though you're taking a haircut. What you're going to be able to use in the proceeds, redeploying into higher returning private equity, is expected to make up the difference. That's kind of the justification.
And Mark, just to add on to that, because the word liquidity came up a little bit earlier. A lot of the secondary is because people are looking for exits for liquidity purposes. If liquidity is not concern, then you need to ask yourself, why would you be looking to sell it? And to Mark's point is, if it's going to return 0% and you see other opportunities as like an opportunity cost to go into different areas of the market, that would likely be the driving reason. The other reason would obviously be, and I think, having the fees here on the right-hand side is also very helpful when you look at, I think Steve mentioned it's about a $320,000 run rate on an annual basis. That should probably be another consideration of, do we want to pay fees if we don't think there's any future value in the fund? So there's a lot of moving levers here. I think it's important that you work with staff, and Mark and consulting team is happy to engage with you on this to make the appropriate decision. But I don't think liquidity is a driving factor for you right now.
It
certainly
strikes
not.
me that our time is getting short, and we've had a useful conversation. It also strikes me that what we have here is a situation where we're going to have a number of these going forward. And the real question is whether or not we want to convene this committee to review each item, each issue as it comes along, or whether we make adjustments to our investment policy statement to provide guidance to the staff as to under what conditions they would suggest or recommend non-continuation recommendations or continuation recommendations. It appears that most times we're going to be recommending continuation because of the general situation in most of these cases. So it strikes me we need a policy about how we manage these items. If we had 21 of these that are 15 years older, I'm sure that we have a large number that are newer than that, but still old and still legacy items. So I guess that would be my thought, is that we should be looking at an adjustment in our policy statement so the staff can move ahead on these items, and under what conditions do they bring it to the investment committee, and under what conditions do they make the judgment based upon the guidelines in our policy statement. That would be my suggestion as we move forward, but we can consider that further. But our time is about out for the next meeting. Are there any other comments or suggestion, or does that seem like an appropriate way to proceed?
I would agree. I think it's a very good, we've had a very good discussion so far, and I'd like to see it continue and refined, and I think it's a good way to go about it, Dr. Hackberg.
Okay, thank you. With that, our time is up, and if no more actions to take up, I'll declare this meeting adjourned.
Okay, we'll see you on